Everybody, and welcome to another Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the deferred sales trust is an amazing way for you to eliminate the need for the 1031 exchange, exit any asset of any kind, unlock freedom and flexibility to invest into deals when they make sense for you, so you can create and preserve more wealth, or help your friends, family, and clients do the same. Hey, my name is Brett Swartz, and I'm founder of Capital Gains Tax Solutions, and I'll be the host today of this podcast. In each episode, we're joined by some of the best real estate, financial, wealth, and business minds in the world, where they share their ideas and deal stories. So together we make complex tax deferral strategies simple and passive income plans achievable. We're also streaming on expert CRE seekers as well. So I appreciate everyone listening or watching us online there on YouTube. Our next guest, he's the co-founder of Greenleaf, an Atlanta-based real estate investment firm. From the very beginning, he has built Greenleaf to be a provider of quality, affordable housing that offers a unique compassion and partnership with residents. And since the inception as a two-man venture, Greenleaf has grown to a geographic footprint to encompass several states in southeastern U.S., and the growing portfolio currently includes apartments, mobile homes, and commercial properties, and so much more. Please welcome to the show with me, Dave Codrea. Dave, how you doing?
Thanks, Brett. Pleasure to be here. Happy to chat a little bit about this stuff. There's a good amount of opportunity out there right now, and lots of people looking for what to do next.
Absolutely. And we're going to be talking about converting office to an industrial flex and ways that you can get a part of this, perhaps if you're a credit investor, with Dave and his team. But before we go there, I want to take one other step back, Dave. I believe we've all been given certain gifts in this life, and these gifts have been given us to be a blessing and help to others. So Dave, what would you say is your one or two real strengths or gifts you believe you were given, and how does that help how you help and bless people today?
Main thing looking at is just how can you build an organization that can empower people to achieve goals that they want to achieve? So it's not necessarily pushing your goals on everyone, but it's, how do you have an organization that can bring people in and enable them to be more successful because of that organization than before they got there? So right now, that's the main thing that I've been working on, and main thing that I believe that I was put here to be able to do is help people achieve what their goals are and what their dreams are.
Fantastic. So I focused on helping people achieve their goals, right? Not just building the company's goals or the founder's goals. I think it's amazing. Let's focus that thought on this, which is, what's the number one secret to converting office to industrial flex?
I think looking for ways that you can take the skill sets you have and apply them to what the current market conditions are. I started 15 years ago buying defunct multifamily that was in super bad shape. No one wanted it. And it was really a struggle to figure out what you're going to do with it. And that same kind of environment right now is bleeding into some of these older office assets that they need a lot of extra love. And you got to find some creative way to use the space. It's there. A lot of it can be had at a good deal. So we're taking really our playbook from 15 years ago on buying kind of terrible multifamily or assets that have been long-term neglected. And we're doing the same thing with office right now and finding what's the best use for that space. And for us, it seems to be industrial flex, at least in the Southeast, is where we're seeing the biggest demand.
Excellent. Yeah, that makes a lot of sense. It's kind of being creative and figuring out ways to take something that perhaps was a little more obsolete and making it to an investment and more adding value to the community and whatnot. And so this is really interesting, right? Because the office space is dying in a lot of spaces. So I mean, talk about the opportunity and what you're seeing, and maybe give us kind of a live example to this, Dave.
Typical deal that we're seeing is, call it 20, 30,000 square feet of a single story building outside of a downtown area. And there hasn't been a lot of demand for it. There hasn't been a lot of use for it. There's a lot of old cubicles in it, and it's a space that can really be converted to kind of any vision you would have for it. So when you start driving around and noticing them, you'll see a lot of that size building that you're like, it doesn't look like it's the cleanest. It looks like something else could be done there. That's really what we're looking for.
Excellent. And so, okay, 20 to 30,000 square feet outside of a downtown area. It's sleepy and tired, and you guys are coming in and saying, okay, what can we do it? So what does it look like, step by step? You find the opportunity, you find the location, and what are you doing to, increase the value and change it into industrial flex?
Yeah, any initial investment you're looking at making, we have our areas that we operate in. We don't really deviate from them. We're not really trying to go find new markets. We're predominantly buying stuff Atlanta to Charlotte. We're comfortable there. So, making sure one, you're comfortable in the area you want to invest in, I think is key start. And then once we have a property or once we identify one, we're really using a lot of our skill sets that we honed over the years in multifamily, which is a lot of construction, a lot of demolition. We're able to take a single story building and really just gut the inside of it, take out all the old offices, remove everything that's in there and get it. So what we call a white box scenario, where you have elevated ceilings, you have large clear spaces, you have, no kind of like divided up minor walls. That really gives someone that's coming in an opportunity, especially in the industrial, the flex, or the warehouse type users, to come in and use that space however they seem, best for their operation.
And are they typically a single tenant or multi-tenant? And I mean, I guess it depends on the deal itself, but who is the ideal tenant or tenants that you're finding to
Yeah.
put into these spaces?
A lot of these spaces are divided into smaller floor plans. So like 4 to 5,000 square feet. You got, smaller suites and places that go in there. Atlanta has a lot of film stuff happening lately. And so there's shops that'll specialize in just like audio equipment, and they'll rent a suite. And then we have everything from small operators that are doing HVAC companies and that kind of stuff, electricians. So a lot of like service providers that have to have a home base are based out of there, or small distribution companies.
Excellent. And then as far as like potential returns, because industrial's been, white hot for a while now, and it doesn't seem to be slowing down. What are you seeing in that space and those trends, and how is interest rates, being that they've increased so much, affecting opportunities to value add, hands-on, development costs?
Well, interest rates impacting, construction loans in a big way. It's a lot harder to even get a construction loan right now. So it's definitely equity heavy on the front end, doing anything that's a turnaround value add position. But kind of, you're taking one asset class that has a lot of headwinds, being office, and moving it to an asset class that has a lot of tailwinds, being industrial. So we're really looking at a variance in the price per square foot, at what an industrial is trading at or what an office is trading at. And we're able to have a pretty good spread there, where, if you can get defunct office space in that, even call it like $60 to $90 a square foot, and flex is worth 100 to 130 a square foot, you have a good spread that you're looking to do. And as long as you can find a way to reasonably turn things in a pretty narrow timeline, you don't want to take 2 years to go do something.
Absolutely.
You can normally do it pretty quick.
Yeah, that makes sense. And we are talking with Dave, and it's Codrea. Pronounce that right? Was that off?
Yeah, it's Codrea, but yeah.
Codrea, that's right. It's Codrea. Like I think of like Cobra Kai. I'm thinking like the like Codrea. Like that would be like the guy's like nickname, right? So
Yeah.
Dave Codrea is spelled Codrea. You can find more about Dave and his team by going to gogreenleafmanagement.com. That's gogreenleafmanagement.com. And I'm looking at this. You guys have a pretty neat, I think, approach to how you guys are doing things. Invest, give back, the careers, over 4,200 residential units, about 1.6 million commercial gross square foot, and then over 125 assets owned and operated, 750 million capital deployed. What are you seeing, and what are you most excited about this shift in the marketplace? You mentioned you hadn't bought multifamily since 2019. I'd imagine because valuations just didn't make a lot of sense for a lot of reasons. So talk to us about what you're anticipating besides just converting office to industrial flex, and what you're most excited about.
Yeah, a lot of times you're looking at deals and people want to buy when things look like they're going in the right direction, but really the best deals are when things are in the wrong direction for a specific asset class. As long as you can operate it and you know what you can do with it. Looking forward to, there's definitely going to be some challenges ahead in a lot of real estate, with interest rates going up so much, and that for the most part impacts the highest leveraged pieces first. So I think over the past really 2 to 3 years, I mean, there's been a huge amount of debt origination just in 2022 alone. There was the most debt origination that we've seen across syndication deals, such as, I mean, multifamily had a lot of it too, but a lot of debt at a lot of high leverage. And that's going to cause some issues as that comes due. And people typically have like a 3 to 5 year commercial loan. So if you think 2024, that's when there's probably going to be some more opportunities to pick up assets where people need to exit them.
I couldn't agree with you more.
Years,
yeah.
Sorry, yeah?
No, you go ahead.
Yeah, no, I mean, the past few years, no one's really had to exit everything. So, it was very much people trying to buy as much as they could. And now we're going to see a shift in that where some people have to exit deals that they're in. And that makes it even more attractive on the buyer side.
Yeah, I couldn't agree with you more, right? And I think a lot of this was driven by, high valuations, obviously very low debt, available debt, and people, just the boom that was going on for a long time. I mean, I remember seeing, this is about a year and a half ago, I saw a 2.9 cap, and I just said, I just couldn't get comfortable. I was like, this is insane. This is insane, right? This is from a big group, and that's very reputable. And it's, of course, the deal, the specifics are in the deal, how much you can raise the rents, how quickly, what's turning over, because it's not just the cap rate, that's just static, right? You need the IRR and the ability to grow the rents or the value add. Like you said, you can operate it, and it's within your expertise. But now we're seeing sellers maybe finally starting to come to the realization that if they need to sell, right, that they're going to have to meet the market at a lower price, because interest rates just, you can have a negative arbitrage on these interest rates with debt being higher than the cap rate. It's difficult to make a lot of sense. And it feels like a lot of the juice has been squeezed by a lot of these deals, right? Because there was just so much activity. So it's kind of this perfect storm of more stagflation, which I like how you guys are taking the approach of the office to industrial flex. Do you anticipate buying deals for multifamily in particular, or from distressed sellers because of the debt situation, or what is your strategy to be in front of that?
Certainly. We think we've started looking at some more multifamily that's coming up, and it's all just tied to loan expirations where you have a loan with pretty low interest rate or variable rate. Both of those could run into issues of having to refinance them and not being able to do so. And that's where we're seeing kind of the inklings of those conversations happening. We haven't actually really bid on much or gone out there to buy much right now, but the conversations are ticking up much more than they were. A year ago, we had no conversations on that front, and now we're starting to have them. And I think 2024 is when we'll see a bulk of those opportunities start coming to light in the market.
Absolutely. And what's your main buy box when you're buying, Dave? And how does an investor work with you guys? Are you, again, matter what states you're in and what you're buying? And are you going to be back into multifamily, or do you feel like you're going to be in more of the creative space, or are you kind of just open to see where those deals come up and you can execute on them?
Yeah, I mean, we're typically buying deals that are under $20 million. So I would say they're smaller, non-large institutional deals. But we're really looking to find deals that are taking them out of a headwind situation and moving them to tailwind. So multifamily sounds like it's going to have some headwinds coming into it. Even our portfolio, we've seen a little bit lower rental rate growth and a little bit lower retention over the past, 3 to 4 months. So see that trend continuing, and we'd certainly like to buy more. I meet with my investment, panel, and we're going through deals. It's like, maybe we can sneak a multifamily deal in here soon. It hasn't happened, but I would say each quarter we're optimistic that we could get one.
I'm curious, what would be some of your metrics for that, right? I mean, cash on cash, cap rate, average rent increase opportunity, IRR. What would be okay, finally the market's here. What would that feel like? I know it's every deal's specific, but how far are you off from where it's been?
I would say we're still pretty far off, but we're looking at mostly factors we want to see population growth in whatever the market is that we're, whatever the city is that we're going into. And that's got to be over a 10 to 20 year period. And then tied to that, we want to make sure our basis, so price per unit, is in line in our ratio of price per unit to the rent per square foot. And that's how we're making sure we can buy an asset that's going to be able to produce the yield necessary, not only to pay investor returns, but to properly maintain that asset condition. We predominantly buy 1 and 2 story stuff as well. We're not looking for towers. We're not looking for big buildings, garden style, lots of land.
Makes sense. And I'm just curious on those ratios, right? Imagine it's a B or better property, B or better location, nice suburb, good, decent school systems, good job growth, good rent growth opportunity. What would be that good buy box for the price per unit versus the price per square foot? What are you looking for there on those ratios?
Our rent per square foot, that's in that low dollar range. So $1 to $1.15, right? So that's where you've got something that probably has a little bit of upside room to it, but it's also not an overly expensive rental rate. And then our unit cost, we want to be under 100,000 a unit. Kind of our top end, we're probably in around 90 on some of our deals that are either in better locations or just higher end build outs. So under 100 a door on pricing and around that $1 to $1.15 to start with on the rental rates.
You know what's crazy, right? Because of how much higher the prices have been, these past few years, and how many more people now are just saying, forget it. Like you can keep the old 20, 30-year-old property. I'll build a brand new one for the same cost that you're buying. It may take me a little bit longer, but what are your thoughts on developing from the ground up, Dave?
I think it could work in unique situations where you typically have to have a lot higher rental rate per foot to recover your costs and time. There is that argument. Yeah, you could go build something, but you can buy something a whole lot quicker than you can build something. So unless you're able to do all of that in-house and really control your timelines, development is no easy task. And I don't think it's something you should just jump into and say you're going to perform really well at. There are people that are excellent apartment developers, but they're excellent because they've been doing it for years, decades. And, they have a phenomenal teams that are able to pull these projects off, and kudos to them. They're very impressive. My organization is not built around development skill sets. We're more operating skill sets. So I think you got to know what you're good at and what you're capable of doing and not try and overextend yourself. So I think sort of answers the question there, but that's that's not my game plan going into real estate.
I think it does, right? I think you had a key point there when you said you got to control the time, if you have done a good job of controlling timetables for delivering product and quicker, obviously that's the word here, right? Because you're going to have to be heavier equity up front because debt is so much more expensive. So if you have a team to be able to do that, you have a competitive advantage if you have that track record, because otherwise the cost is going to catch up with you. It can be a big challenge. Excellent. I want to shift a little bit, Dave. We believe here at Capital Gains Tax Solutions that buying an optimal timing, like kind of all the stuff that you're saying, like staying within your lane for what you're really good at, and then not deviating from those parts of it. And for the investor who might be selling out of a business or commercial real estate, or and they have this huge capital gains tax, right? And maybe you get those calls where they say, look, I'd love to invest with you, Dave. I want a 1031, and you may or may not have a fund that qualifies them to be able to do that, or you don't have a deal lined up to do like a tenant in common type of structure. But what would you say is your biggest frustration when it comes to capital gains tax and the 1031 exchange?
I would say not having a plan. A lot of times you'll see people that they made a lot of money, they have a 1031, but then you kind of get annoyed that you have to pay taxes. It's like that's the result of making a lot of money, is that you then have to pay taxes. So unless you're open to what the potential solutions are to solve that or to defer them, you got to be creative in what you're looking to do. But I would say most kind of like challenging or frustrating part of it is that everyone knows if you earn money, you have to pay taxes. So you can't not be aware of that. So I think every time you're looking to sell an asset or you're looking at your plan going forwards, you've got to look beyond just the current deal, just the execution of the closing, and know what your long-term plan is, and then you have a way of executing it.
Excellent. And on the front of 1031 exchanges, when you guys are exiting and doing assets, how is your structure? Are you guys syndication model? Are you guys fund model?
Yeah.
You guys a little bit of both?
Yeah, so
walk us through
that. We're
an
individual deal fund model. I mean, we're individual deal, not a fund model. So as we look at exiting a deal, we're going to then say, hey, this is a candidate. We're going to go do a 1031 exchange and find something. But if we can't find something, no one really wants to have a situation where you can't place money and you have that big capital gain at one point. I mean, that's where the DSTs are useful as well. If people have a deal that they know they want to exit and they want to move away from just owning one asset, it's like it's a great way to do it. But they should go in with that plan ahead of time and not wait till the last minute to try and figure it out.
Yeah, I could agree with you more. We call it the shotgun wedding, right? When you're forcing a marriage in 45 to 180 days in a situation where you don't necessarily want to be in, especially with interest rates being so much higher right now and values not necessarily shifting as quickly as they might be. And so having an option like the deferred sales trust to exit, defer your tax, and then invest at optimal timing, all tax deferred, into real estate. The 2008 crash, it took till 2011 to see the bottom of real estate values, right? Not that we think that's coming or anything, but there's definitely some challenges ahead. And the question is, how long is it going to take for those values to shift? And so having liquidity, diversification, the ability to pounce is great. Also, from someone like your perspective, I would imagine too, Dave, that people might call you with a business sale. They might call you with cryptocurrency or stock or something, a primary home that's not even 1031 eligible to go into a 1031 like a tick carve out. And they're going to pay a bunch of tax, but they want to be in real estate because it's very stable and they trust your track record and everything you guys are doing. This deferred sales trust can be that bridge that bridges the deferral of the tax right into your deal without having to be a 1031 or a carve out. It just comes in as an LP. It's just seamless, just like any of your other LPs. What are your thoughts on that, Dave?
I mean, it's a great strategy, a great solution for doing it. I would just say, in my shoes, I'm purely the real estate operator looking to put LPs together. So we don't necessarily go try and do all that stuff in-house, right? Like we want to partner with someone that's able to do that for an investor. So it's a smooth process. Like we know our skill sets and, in your shoes operating the DSTs, like it's not something you just sign up for day one and say like, hey, I can magically do this as well. So I think you just making sure you have the right people in place and the right partnerships on how you're working with individuals. And it can be a huge advantage to people that are taking the time to, learn what the best scenarios are out there.
Absolutely. If people want to learn more about that, you can go to capitalgainstaxsolutions.com. You can also check out the new book that just got released, Building a Capital Gains Tax Exit Plan, hit #1 bestseller on Amazon for some of the categories like real estate and investing in wealth. So check that out. That being said, Mr. Dave, are you ready for the lightning round?
Yeah, let's do it.
All right. Knowing what you know now, if you could go back to your 20-year-old self with the one gold nugget, you make sure to tell yourself to do.
20. That would be an interesting time, but no, just staying focused.
Absolutely.
Just staying focused.
Yep. Question number 2, what's the #1 book you've recommended or gifted the most in the past year?
I love this book, Boyd. I mean, I've read it a bunch. I think it's an excellent book.
Say it one more time.
Boyd, B-O-Y-D.
Okay. Excellent. All right, Boyd. Question number 3, what are you most curious about right now?
I'm curious about what's going to happen with big office towers. That's probably what I think about the most. We're not in it, but I think it's super interesting what's going to transpire with those. Second
to last question. What's the #1 leadership quote or theme that you strive to live by?
There's a Steve Jobs quote that's basically don't try and do everything, just do one thing well. So going back to staying focused at age 20.
That's good. That's great. Last question. After all your success, helping all the people you've helped, what would you say is the practice that you try to practice or the habit you try to practice to help you stay centered in your values and stay charged up to reach even higher heights?
There's got to be some way that you're volunteering or giving back or focusing on helping other people outside of your organization and doing that as much as you can.
Excellent. Giving back, serving, blessing other people. Dave, I want to thank you for being on the show. It's been more than a pleasure to have you on the show. Tons of wisdom, a lot of nuggets, and a lot of practical thoughts on the marketplace right now. And I want to encourage you to keep using the gifts and talents of helping people achieve goals, their particular goals, right, for what they want to do, and then creating great opportunities for people to create and preserve more wealth in real estate. For our listeners who want to get in touch with you, would you remind them one last time what's the best place for them to find you?
Yeah, best our website. Just go greenleafmanagement.com, or I'm on LinkedIn as well under Dave Codrea and Greenleaf.
Amazing. Thanks, Dave. And I also want to thank everyone out there on YouTube or on our podcast for listening to another episode of the Capital Gains Tax Solutions podcast. As always, we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy. Using a proven tax deferral strategy such as the deferred sales trust and or investing alongside groups like with Dave, like his Greenleaf, there are amazing ways to create and preserve more wealth. If you want to learn more about how to build a capital gains tax exit plan, go to capitalgainstaxsolutions.com or check out the book, Building a Capital Gains Tax Exit Plan. Appreciate everyone out there at the Expert CRE Secrets YouTube channel as well. And we will talk to everyone again soon.